All right, so this morning, Thorsten Slok, he's the chief economist over at Apollo. He made this interesting statement talking about the extreme index concentration of the S&P 500 in tech. He says it was obviously not good for investors seeking to diversify their investments across 500 different companies. Anyone invested in the S&P 500 index today is basically making a bet on the Magnificent Seven stocks propelling even higher. I will say this is odd, right? Because maybe it's a dilemma for Wall Street because they have a lot of products that they need to sell. And maybe one day it's going to be a dilemma for investors. But most people who are investing are looking to make money. They're not necessarily seeking this sort of diversification. They like making this cash, and they're making a lot of it. I'm going to bring in Albion Financial, their chief investment officer, Jason Ware, because, Jason, you have been overweight in technology. Are your clients complaining right now that you're not more diversified? They like more consumer staples and real estate stocks?
Charles, always good to be with you. No, we have not heard that. I mean, diversification is important. You don't want to put all of your eggs in one basket, as we all know, but being overweight to the best companies in America, quite frankly, the best companies on planet Earth, I think has been great for our clients. It's been great for everyone who's had exposure. Even if you just have exposure through the S&P 500, about a third of your investments are in these top 7 stocks.
Right.
So
they've
no
carried the S&P.
on Albion's end.
They've carried the S&P. We're going to put a chart up here because right now, you know, I can remember when not long ago there was a lot of complaints about them being 25% in the S&P, then 30% in the S&P, then 38%. We're almost 40% in the S&P. Is there a point where you do start to become worried and maybe say, hey, I want to ease out of these names a little bit?
Yeah, it's a great question. And there's 2 ways that we look at that. One is valuation. When you have these stocks get to a point where valuation no longer makes sense, then we trim and rotate and we look for other areas. Second, we have to remember, we all focus on the concentration that these stocks carry within the index, but we have to remember their profits, the amount of profit and free cash flow that they contribute to the S&P 500 is equally as large as their weighting in the index. So I think as long as their profit contribution to the S&P 500 remains consistent with their weighting, then I'm not too concerned about it.
All right, I want to stay on this topic a little bit, taking profits, and I want to give you some props in the process. February 24th, you offered the audience 10 names. They're up huge. 7 of them are up really huge. Oracle, the biggest one, up 39%. I want to. Are you still holding all the names in green? Are you still holding all of those, or have you started to ease out of any of them?
No, we still own all of them. We continue to be bullish on the companies. We have to remember, Charles, that when we own stocks, going back to fundamentals of Ben Graham, Peter Lynch, et cetera, we own a share of the business. And those businesses right there to your left continue to look good and valuations aren't too stretched. So we still own them for clients and we want to be in them long term.
On the downside, the Apple and the Salesforce.com, people starting to lose faith in those names.
Yeah, a little bit. I mean, Apple certainly has its headwinds. Mainly it's trading at 30 times and people are wondering where growth comes from. We're still bullish on Cupertino. We think the consumer AI experience is going to be experienced through iPhone. We think the services business is still intact, so we like that. And then as we look at Salesforce, we think agentic AI is going to be huge and they're leading the way. It's always a good bet to bet on Mark Benioff, and we still like Salesforce. It's trading at the lowest valuation over the last 15 years, trading at mid-20s.
I can't believe it. The Apple, first company to $1 trillion, $2 trillion, then $3 trillion valuation. Not the first of $4 trillion. Now everyone's saying, let's get rid of Tim Cook. All right, before we go, I want to talk about names or some of these symbols that are primed to go. We don't necessarily have time to go into depth in all of them, but you know, some of these names are maybe we haven't talked about on this show. Fiserv, for instance, that's a name that many guests. It's the first time I heard it in a long time on this show.
Yeah, it's been getting a lot of attention, not for the right reason. Their Clover volume growth came in below expectations, just slightly, and the stock's been down, but it's trading at the lowest valuation since we've owned it, and we've owned it for over a decade. So Fiserv is a great growth at a reasonable price story, GARP story. As I look at the other ones like Amphenol, we bought it in the mid-60s, literally on DeepSeek day, and it's up 50%. So that one's stretched, but it's still got such a great business. So a lot of great names on your screen there.
30 seconds. Starbucks is another name you're looking at here. It's that fundamental, technical.
Brian Nickel. It's Brian Nickel. I mean, they brought him in to turn it around, and he's got a great track record. We're going to stick with him.
You know what I tell people all the time? If your big long-term investments have to be based on management. And his track record, to your point, is phenomenal. Jason, congratulations, my man. Thank you very much. Appreciate you.
Thank you. Appreciate the support.